Bookkeeping basics. This is the beginner video for any business owner or any bookkeeper that's wanting to start a business. This one's for you because it's gonna be, at the beginning confusing and complicated, especially if you have no experience in this. Most business owners don't. Bookkeepers are obviously gonna have experience in this. So this video is gonna kind of shed some light on everything. Number one, the biggest thing is just understand that bookkeeping is pretty much categorizing transactions. We're taking, your bank statements and we're looking at all the transactions on that bank statement and we're saying, all right, this was meals, this was auto gas, this was auto repair, subscriptions, stuff like that. And we're just putting it all into buckets, right? And then things get kind of complicated once we start moving from that, because that's pretty simple. If your business is just straight expenses and income, not hard. But once things start getting complicated is when we start adding loans into it, or assets into it, or AR, or in other words, accounts receivable. We start adding that stuff into it, then things start getting a little more complicated. So what I'm going to start with is AR and AP, which is accounts receivable and accounts payable. Accounts receivable is like if your business is run on invoices, if you're, I don't know, a painter and you invoice a customer $1,000. What's going to happen is you're going to, QuickBooks is the easiest way to do is I use QuickBooks for all my invoicing. So what I'm going to do is just create an invoice in QuickBooks, and then I'm going to send it to that customer. That customer owes me $1,000 in some set of time. So for that set of time, that $1,000 is going to sit in QuickBooks on my balance sheet as accounts receivable. So that is going to sit there as an asset to me because that's money owed to me, right? Now, once it's paid, I no longer am owed money no more. They don't owe me money no more. Now it's paid, but I don't have it in my bank account yet. So there comes an issue. We need to move that money, but we can't move it really from accounts receivable to the bank yet because it hasn't happened yet. It hasn't gone there yet. So what we're going to do is move it from accounts receivable down to undeposited funds. This is where it's going to sit until our bank account shows a deposit. And then it's going to sit there, and once it does, once that money hits the bank account, then it's going to pair it, and we're going to go in there, click pair, and it's going to pair it, and then it's going to go from undeposited funds to our bank account. And that's kind of the progression. Every single time, it's going to go from there to there to there. That's pretty much the accrual accounting basis. It's not super complicated, but it can be if you don't understand it. The next is accounts payable. Accounts payable is the exact same thing except for it's opposite. So we are signing an invoice for some supplies or something. Our company needs this supply. We're doing it net 30, which means that we're going to pay it in 30 days, right? So what we're doing is we're saying, hey, I'm going to pay you in 30 days. Well, that now is going to go on our balance sheet as a liability because it's money that we owe somebody. So it's going to sit on that balance sheet until we pay it. Once our bank account, registers that we've paid it, then it's going to show that money is leaving our bank account, and then it's going to go from accounts payable and reduce the accounts payable. Sorry, going to go from bank account and reduce the amount that's in accounts payable. And then we no longer owe that money, right? So that's the accrual accounting basics. Obviously, it gets more complicated with other things, but we're just going to go over the beginner basics right now. And so that's kind of the biggest things that you're going to need to know about the accounts receivable, accounts payable. Now, once we get into, so we categorized everything, so we've done our accounts payable, but now things get more complicated with like loans. Loans, a lot of people get confused with this. They think, okay, I paid $260 to my loan to pay it down, right? So they take that $260 and they put it on the expense or a profit loss. They put it as an expense. Well, that's wrong. It's actually going to go, and so it's going to be split in two. So your principal is going to go and reduce the amount that you're owing on the loan. And then the rest of it that's on there, because it's going to show you how much is left, or how much is left over after the principal's paid. It's going to show you what interest is on there, and that is going to go on your profit and loss. That's what's going to be expensed and what can be written off. So it gets complicated, but it's not really. It's just you're going to need to look into the loan and see how to split it. And QuickBooks makes it pretty easy by putting a split button down there, and you just put what your principal was and what your interest is, and split it, pay down with the principal, and then put the interest onto your balance sheet. And it's very important because, if you just put the whole thing on your profit and loss, you're over exaggerating your expenses, and it's really not going to be good once the CPA looks at it. Hopefully they catch it, and hopefully the IRS, it doesn't go to the IRS, and that's an even bigger issue. But that's kind of the loans and stuff. And then the assets are kind of the same deal. Where it's going to be a little bit more complicated. Like if you buy, I think it's $2,500 is the cutoff. If you buy, let's say a ATV or a truck or something, and you're going to use that for business purposes, obviously, and costs more than $2,500, then it's going to go onto your balance sheet as an asset. And then as your CPA is going to take that and depreciate it over time. There are ways to upfront the depreciation now, especially the new laws and stuff. What you're going to have to do some extra steps to get to that. Talk to your CPA about that. I'm sure they can help you and everything at that. But once you've done that, it's going to sit on your balance sheet, and you're going to take a little bit of depreciation each year to depreciate it over time. That is the main thing. If it's under $2,500, I believe that if it's like a computer or something, you can put it all on your profit and loss. But again, talk to your CPA about that to make sure that you're doing that right. As a bookkeeper, if you're a bookkeeper, I would always stay on the safe. It's over 2,500, throw it on the balance sheet, let the CPA decide whether or not they can depreciate it all up front or over time. But that is pretty much all the basics. There's a ton more that you need to obviously know, but the main pieces that you're gonna need to get started is all right there. Transactions, understand your transactions and categorize them correctly, put them in the right buckets. Your AR and AP, that's huge for bookkeepers. I mean, it's huge for obviously service-based businesses that are running these invoices and stuff, but it's huge for bookkeepers because you can charge quite a bit of money for that service because it's kind of a more hands-on service. You got to stay on top of that stuff. And then make sure that you understand, you're splitting stuff, your loans, and then your assets, put them on there, and everything. Keep track of your liabilities. That way you're paying them back down. And, that's pretty much the basics of bookkeeping. It is complicated. When I first started this, everything was like all over the place and so confusing. But I can take over your books if you really need the help. I'll put my link in the description below, jonesbookkeeping.pro. If you visit that site, you can book a call with me. We can discuss your business and see if I can help clean up your books, especially since it's January. The tax season is upon us. So let me know if you need help.